Then in part B, we need to reconcile the net income according to the two methods. So in order to perform the reconciliation, you start with your absorption costing profit. So that comes directly from your absorption costing statement. You are then going to add any difference in opening inventory, deduct any difference in closing inventory, and that will give you your variable costing profit. And you'll see that ties into your profit as per your variable costing statement. Now you can perform this calculation in either one of two ways. Either you can just look at your opening inventory and your closing inventory that's sitting on the statements and calculate the difference between the two. So in other words, take the rand value of your opening inventory as per your absorption costing statement. That is the rand value of your opening inventory as per your variable costing statement. Get the difference between the two. Then the same thing for closing inventory. That is my closing inventory value as per my absorption costing statement. Deduct the closing value inventory as per your variable costing statement and get the difference in your closing inventory. And you will then see that that reconciles. As an alternative, and what also makes more sense logically, is you can look at the calculation in this way. Remember, when we calculate our absorption costing profit, we include both our variable and our fixed production costs in the cost of inventory. However, on the other hand, when we calculate our variable costing profit, we only include our variable production costs in the cost of inventory. So, both of these take our variable production costs into account, and the only difference between the two approaches is our fixed production costs. With absorption costing, we include our fixed production costs in the cost of inventory. With variable costing, we expense the fixed production costs in the period incurred. So if our fixed costs are the only difference between the two, remember we are trying to calculate the difference between the two. The fixed costs are the difference between the two. So we can take into account the fixed costs in opening inventory and the fixed costs in closing inventory, and we can also perform the calculation in that way. So we calculated in step 1 of our calculations that our allocation rate for our fixed production overhead is R5.20 per unit. So all you need to do is you take that R5.20 per unit and you multiply by the number of units in opening inventory. And please remember, in this example, the company had 4,000 units in opening inventory. So 4,000 units multiplied by R5.20 will give you your difference in opening inventory. The difference between the two is your fixed costs that are sitting in opening inventory. We do the same thing for closing inventory. My fixed overhead allocation rate is R5.20 per unit. We calculated that there are 2,000 units sitting in closing inventory, so that gives us a difference of 10,400 Rand. All right, so please make sure you can prepare this reconciliation. You can reconcile the difference in profits between the two approaches, and please make sure that you understand the only reason for the difference in profit between the two approaches is because of your fixed costs that are sitting in opening and closing inventory. Then in part C, assume that the high level of production is considered to be materially different from the budget. What should the value of inventories be in terms of IAS 2? So please note, guys, in this question we were given normal capacity to be 30,000 units, and our actual production was 32,000 units. So they are telling you to please assume that the high level of production is materially different from the budget. So they actually ended up producing 32,000 units, and you need to assume that that is materially different from their normal capacity or their budget of 30,000 units. And if we assume that, what should the value of inventory be in terms of IAS 2? Now I want you to go back to the extract from IAS 2 that I provided you with. I left this out and I said I was going to come back to this. we are told that in periods of abnormally high production, the amount of fixed overheads allocated to each unit of production is decreased so that inventories are not measured above cost. So this is what IAS 2 is telling us. They tell us if production is abnormally high, and in the required they specifically tell you to assume that production is abnormally high. So if production is abnormally high, the amount of fixed overhead that we allocate to each unit of production must be decreased so that inventories are not measured above cost. So let's look at how you need to perform this calculation. All right, so first I've just started with the extract from IAS 2. In periods of abnormally high production, the amount of fixed overheads allocated to each unit of production is decreased so that inventories are not measured above cost. Now please note, you should not perform this calculation unless the required specifically asks for this. So in this question, the required specifically asks us to perform this calculation, and that's why we are doing this. Don't just do this if the question is silent. You only do this if you are specifically required to do this. And then I want you to perform this calculation in 3 different steps. In step 1, you are first going to recalculate the overhead recovery rate based on actual production. So I want you to go back to where we originally calculated our allocation rate. So when we calculated this allocation rate over here, we took our budgeted overhead for the year and we divided by normal capacity. We are now just going to recalculate this rate, and instead of using normal capacity in the calculation, we are now going to use our actual production. So we still take this budgeted overhead cost, but we now divide by our actual production of 32,000 units. So that gives me a rate of 4.875 per unit. The old rate that we calculated previously was R5.20 per unit. So because production is considered to be abnormally high, we are now going to write down the value of inventory. So originally, when we valued our inventory, we included fixed overheads at a rate of R5.20 per unit. We are now going to write this down. So in step 2, you calculate the difference between the old and the new rate. So we get a difference over here of 0.325. Then lastly, in step 3, how many units do we have in closing inventory at the end of the year? Please remember that we calculated that there were 2,000 units sitting in closing inventory. So we are going to write down those 2,000 units based on what we calculated in step 2 above. So our inventory write down is going to be 650 Rand. So if we need to write down inventory, we are going to credit inventory with 650 Rand, and we are going to debit cost of sales with 650 Rand. So all we are doing is we are writing down the value of our inventory to make sure that it is not measured above cost. Originally, when we valued inventory, we valued it at a rate of R5.20 per unit. However, because production is considered to be abnormally high in this question, we need to write it down to 4.875 per unit. So this is the value that I must write my inventory down by. So what impact will this have on my closing inventory? That is your closing inventory as per your absorption costing statement. Remember, this will only affect our absorption costing statement because this has to do with our fixed overheads. If you go back, please remember all of this information over here relates to IAS 2, which means we are using absorption costing. So this won't have any impact on your variable costing statement because we are allocating fixed costs to inventory when we are using absorption costing. So if our production is considered to be abnormally high, the amount of our fixed cost that we allocate needs to be reduced so that inventory is not measured above cost. So this will only affect our absorption costing statement and not our variable costing statement. So if we go back to the absorption costing statement, Inventory was valued at 32,400, so we are now going to write down the value of inventory. So the impact will be that my inventory is now valued at 31,750 Rand. So we've written down the value of our inventory, and that will have the impact of increasing your cost of sales. Why will it increase my cost of sales? Please note that we deduct closing inventory from the value of cost of sales. So if my closing inventory is going to decrease, that will have the effect of increasing my cost of sales. So you can take your cost of sales amount and increase it by 650 Rand to get your new cost of sales amount. And then you can even prove the calculation. If you reperform the calculation as per your statement of comprehensive income, take the value of your opening inventory, your material cost, your variable production overheads, your fixed production overheads, and now make sure that you use the new value of closing inventory and not the old value. So that's the new value of closing inventory that we calculated above, and that will then give you the correct value for cost of sales. So that is what you need to do if production is abnormally high. What should you do if production is low? Again, go back to the extract from IAS 2. The amount of fixed overhead allocated to each unit of production is not increased as a consequence of low production. Any unallocated overheads will be recognized as an expense in the period in which they are incurred. So in other words, if production is low, you do nothing. Now, I just want you to go back to our example so that you can understand this properly. If we look at our absorption costing statement over here, in this example, actual production was higher than normal capacity. Normal capacity was 30,000 units, actual production was 32,000 units. So because we actually produced more than our normal capacity, we have a favorable volume variance over here. And remember, because it's a favorable variance, it gets added back to our profit as income. So if actual production is higher than your budgeted production or normal capacity, you are going to have a favorable volume variance and you are going to add that back as income. On the other hand, if the company actually produces less than their budgeted capacity or less than their normal capacity, then please note this is going to be an unfavorable variance. And if it's an unfavorable variance, it will be treated as an expense on your statement of comprehensive income. So that's all they are saying over here in IAS 2. Any unallocated overheads will be recognized as an expense in the period in which they are incurred. All they are saying is if we have low production, so your actual production is less than normal capacity, you will then have an unfavorable volume variance which will be an expense in your statement of comprehensive income. Remember, if we have a favorable variance, it is treated as income in your statement of comprehensive income. If it's an unfavorable variance, it will then be an expense in your statement of comprehensive income. So you won't need to do anything because this expense will already be sitting on your statement of comprehensive income. You would have calculated your volume variance, you would have had an unfavorable volume variance, so you would have shown that as an expense. So because of the low production, you will have an expense or an unfavorable volume variance. But it's important to note that the amount of fixed overhead that we allocate to each unit of production is not increased as a consequence of low production. So where we had abnormally high production, we went and we recalculated our fixed overhead allocation rate and we wrote down the inventory. If you have low production, you do not go and recalculate your allocation rate or anything like that. You don't do anything. So if there's abnormally high production, we saw in part C of the required, we write inventory down to make sure that it's not measured above cost. We only do that if production is abnormally high. If production is low, in terms of IAS 2, the amount of fixed overhead that we allocate to each unit of production is not increased. Or in other words, we don't recalculate the allocation rate. We leave the allocation rate at R5.20 per unit. We don't change anything. So therefore, if we don't change the fixed overhead allocation rate, the value of inventory also will not change. We also saw in IAS 2 that any unallocated overheads will be recognized as an expense in the period incurred. In other words, we will have an unfavorable volume variance. Then there's one section that I left out that I just need you to go back to, please. I said to you we will come back to the arguments in support of variable costing and the arguments in support of absorption costing. So let's go through each of these now. So obviously, if we are talking about the arguments in support of variable costing, these are going to be the advantages of variable costing. So what are the advantages of variable costing? The first one is it provides more useful information for decision making. Please remember that variable costing is used for internal decision making purposes. So it's important that we have the information in a format that can be easily used for decision making purposes. So if you go to your variable costing statement, the benefit of this statement is we can clearly see the separation between our fixed and our variable costs. First, we deal with all of our variable costs, and sales less all of our variable costs leaves us with contribution, and then separately we have our fixed costs. So this helps for decision-making purposes where we can clearly see our variable costs and our fixed costs separately. Another advantage of variable costing is profits are not distorted by fixed costs being allocated to products, or in other words, fixed costs being carried forward in closing inventory. Again, go to your statement. You will remember with absorption costing, our closing inventory has a higher value because it includes both our variable and our fixed production costs. On the other hand, with variable costing, our closing inventory has a lower value because it only includes variable production costs. Now, this specific statement is saying that our profit over here is distorted because our fixed costs are not being expensed in the period incurred. We are not expensing the full fixed cost. some of our fixed costs are sitting in closing inventory, meaning that they will only be expensed in the next period when they get added back as opening inventory. On the other hand, with variable costing, our full fixed cost is expensed in the period incurred. We don't have any fixed costs sitting in closing inventory being carried forward to future periods. So the problem with absorption costing is managers can use this to manipulate profits. And all they need to do is they need to make sure that they have a lot of units sitting in closing inventory. So deliberately just increase production. You don't even have to worry about increasing sales to improve your profits. All you need to do is increase production. Because if you increase production, you will have more units sitting in closing inventory. And because of the fixed costs being allocated to closing inventory, that means your closing inventory is going to be inflated, your cost of sales will be understated, and you can then inflate your profits. This isn't as easy with variable costing, because with variable costing, even if you increase production, you only have variable costs sitting in closing inventory, and your fixed costs are still going to be expensed in the period incurred. So that's another reason why management accountants prefer to use variable costing for decision-making purposes. Then another advantage of variable costing is it's easier to determine the effect of volume changes on profit. So in other words, if we are looking at a variable costing statement and my sales volume increases, if sales volume increases, my profit will increase. If sales volume decreases, my profit will decrease. So it's easy to determine the effect of volume changes on profit. On the other hand, guys, with absorption costing, it is possible to have a situation where you have your sales volume decreasing, but you've got profits increasing. And the reason for that is because of the fixed costs sitting in opening and closing inventory, which are distorting profits. And the last advantage of variable costing is it avoids fixed costs being capitalized to unsellable goods. So again, just go to your statement of comprehensive income. You might be faced with a situation where at the end of the year, the company has closing inventory that can't be sold. So they've got units here sitting in closing inventory that can't be sold. Maybe it's obsolete inventory, etc. And you might only pick this up in a future or a later accounting period and write it off. So right now, your closing inventory is actually overstated because it includes obsolete or unsellable goods. And if closing inventory is overstated, then your cost of sales is going to be understated and your profits are going to be inflated. So we've got fixed costs being capitalized to inventory and not being written off in this period. They will only be written off in a future period when they are added back as opening inventory. On the other hand, with variable costing, we only include variable costs in the cost of inventory. Our fixed costs are expensed in the period incurred, so we are not capitalizing any fixed costs to unsellable goods. Instead, the full fixed cost is expensed in the period incurred. If we then look at the arguments in support of absorption costing, or the advantages of absorption costing, the first one is it does not understate the importance of fixed costs. Now, this is not a valid argument, but I'm going to explain it to you anyway, and then afterwards I'll explain to you why it's not actually valid. So if we go to our statements, what this argument is saying is if variable costing is used, then when managers make decisions, they will only take variable costs into account and they will ignore fixed costs. Now, that isn't a problem of your accounting system. That is a management error. That's where you've hired managers who don't know what they're doing. Whenever we have managers making decisions, they should always take into account all relevant costs and benefits, whether it's a fixed cost or a variable cost. So for all of the variable costs and for all of the fixed costs, management should consider whether they are relevant to their decision or not. They should not only focus on variable costs when making decisions. Fixed costs should also be considered. So this argument is saying if variable costing is used, then managers will ignore fixed costs when making decisions. And that's not a valid argument over here. That is a mistake that managers are then making, and it's not as a result of a faulty accounting system. Another advantage of absorption costing is it avoids fictitious losses being reported. So you might have a situation where with variable costing, you report fictitious losses. So when can this happen? Let's say we're dealing with a company that has seasonal fluctuations in their sales. So let's say, for example, we have a company that makes winter boots. And for the first couple of months of the year, they don't have any sales because nobody's buying winter boots. It's still summer. So for the first couple of months, these sales will be very low. However, because fixed costs are not included in the value of inventory, because we expense the full fixed cost in the period incurred, that could cause the company to report losses. Because for the first couple of months of the year, sales will be quite low because they won't sell any winter boots. They will be expensing their full fixed cost, so then they might report losses during those months. On the other hand, with absorption costing, what happens is they do not expense the full fixed cost in the period incurred because fixed costs are allocated to inventory. So if the company produces a lot for the first couple of months, but they don't have a lot of sales, what will happen is those units will be sitting over here in closing inventory, and the fixed cost will be allocated to the units in closing inventory and will not be expensed in this period. So even though your sales will be low for the first couple of months of the year, because the company isn't expensing the fixed cost yet, they won't necessarily report losses. They will only start expensing this fixed cost in future periods when they actually start selling the units. So what happens with absorption costing is we are matching the expense to the period when we actually generate the income from the sale of the product. So this avoids fictitious losses being reported because your fixed costs are only expensed in future periods when they are added back as opening inventory. So if we do have a company that has a lot of seasonal fluctuations, it might be better for them to use absorption costing instead of variable costing. Another advantage of absorption costing is fixed overheads are essential for production. A company cannot produce the units that they need to produce without incurring fixed costs. So therefore, fixed costs should be allocated to units produced. And lastly, we also know that absorption costing complies with IAS 2. So if we are required to prepare financial statements for external use, we need to make sure that they comply with IFRS or IAS 2. And in that case, absorption costing must be used. All right, guys, that then brings us to the end of this lecture. Please make sure you are comfortable with everything that's been covered in this lecture. If you have any problems, let me know. Thank you.